Stock Market Basics, Part 1. In this section, we'll be covering what exactly a stock is. Then we'll look at why companies issue stocks for sale. And finally, we'll look at what causes stock prices to go up or down. What exactly is stock? When a company creates stock for sale, they're offering a partnership opportunity in their company. When you buy and own a company's stock, you're investing in that company as part owner, making you a shareholder. What exactly determines a stock's price? Let's say the Acme company needs to raise $1 million. So the company's board of directors vote to issue stock shares through what is called an initial public offering, or IPO. They issue 1 million stock shares valued at $1 each. To do this, the company makes a deal with a financial institution to bring its new shares to market. Now, from day one on, just about anyone who wants to can own these shares. They can now be purchased or sold on the New York Stock Exchange. In the example, again, each share of stock would cost the buyer $1. Why might a company issue stock for sale and why you might want to buy it? There are many reasons why a company may want to sell stock, as well as many reasons why you might want to own it. Listed here are some potential press releases put out by Acme prior to or after their initial stock offering. Let's go over these. For example, Acme just patented a new type of drug that both cures and heals chronic disease. Or the second one, Acme's current best-selling product needs immediate funding for mass production to fill a backlog of orders. Or how about Acme requires more money to enhance and improve on an already successful product line? Or maybe Acme requires capital to expand and hire more workers to increase productivity. That sounds like a high-class problem to have. Wouldn't you want to be a partner with a company like that? Or how about this? Acme wants to expand its operations by purchasing another company that sells different products so Acme can expand on its own product line. And finally, Acme just needs money to fund research and development of potentially new products. So companies could raise money for any one of a number of reasons, and they look to the stock market to do exactly that. What determines a stock price? Continued. Simply put, it's based on supply and demand. A limited number of shares that are sought after by many, many people would of course push the stock price up. Another thing that would push the stock price up or down would be news coming out from the company. Press releases such as those covered in the previous slide. And finally, the overall stock market condition and economy in general could determine the stock's price. Did you know, in the old days, stock certificates were issued on paper held by their respective owners? It may have been placed in a safe or safety deposit box for secure keeping. Today, transactions are all handled both securely and electronically through stockbrokers. A stockbroker is a company in charge of buying, selling, and managing your brokerage account. Sort of like a bank account, today's brokerage account is a sort of electronic safety deposit box that holds your stocks and money, also known as your investment capital. So looking back at Part 1 in summary, companies sell stock to raise money for any one of a number of reasons, such as those covered. The stock's price initially is based on the amount of money the company is trying to raise during the initial public offering, or IPO. After the IPO, the stock's price is determined by supply and demand, news, and overall market conditions. And finally, the purchase and sale of stock is generally handled by a stockbroker who performs trades on your behalf in your account electronically. This concludes part 1 of this program.